basically agentic capabilities to make it so that we can do the regulatory reporting there, surveillance. There's a lot of places where efficiency can be gained here.
I wonder about the tokenization that we've seen at Robinhood. You know, they're allowing Europeans to trade U.S. securities through tokenization.
Without having the underlying cash flow. I think that's an important part of this, too.
How do you view that, and what can that do for the industry?
Well, so to me, tokenization is a technology. It's a way to, so the technology itself can be used to do a lot of new things. But when we're looking at how it's being used right now in public securities, I think that it's really kind of a very similar construct to contracts for difference, which has existed in Europe for many years, where you own a financial interest in the company, but not the underlying shares themselves. We also have things like fractionalized shares in the United States and owning fractional shares. It's the same kind of idea. So far, what we've seen in terms of that tokenization is really just a new technology to deliver a similar thing where you can have a financial interest without actually owning the underlying equity. At the end of the day, that underlying equity ultimately does need to be bought, though, and owned, and that then, of course, flows into the market. So to us, it's just another way to use that technology to open up access to
But will
retail.
you use it, too?
So we provide the foundational infrastructure that allows retail brokers to offer things like that, to allows the data. The data is super important to that. We have obviously our own index products where we'd love for them to be able to offer those out through this new technology. But we're very excited to work with the industry on this as an enabler and as the core infrastructure.
Very interesting. That is NASDAQ Chair and CEO Adena Friedman. Lastly, on tokenization, place that's moving pretty quickly here. We will keep an eye on it. Now, still ahead, we're talking about Blackstone's profit jumping 25%, even without a big comeback in deal making. We're going to sit down and hear some of the conversation I had with President John Gray about what's driving that conversation in just a few moments. This is Bloomberg Open Interest. Let's go to check on these markets because we are up on the S&P 500, about 0.1%. Hard to say we're flying, but we are certainly looking pretty good near record highs. NASDAQ 100 up another 0.1%. I've got to say, really interesting here. You have most of the Magnificent Seven up on the day, but Tesla being your big drag on the morning. Now, the 10-year yield is higher, about 3 basis points at 4.4%. But of course, this market is shrugging it off, Matt.
Yeah, absolutely. Looking at new record highs, only up 0.1%, but we soared yesterday after our program. Coming up, June new home sales data coming in below forecast. We'll take a look at the real estate industry next. This is Bloomberg.
And this is Bloomberg.
I want to check in on Blackstone shares. They are jumping after the asset manager, the world's largest alternative asset manager, posted a 25% jump in profits. And that's thanks to retail and evergreen funds, new smaller investors getting in. This morning, I caught up with the company's president and chief operating officer, John Gray. Take a listen.
Medline is a terrific business, and we own a number of other terrific businesses. And there are often considerations to individual businesses in terms of operational things, transactions, other reasons why you make decisions. But it's also, as we've talked about, a function of the market backdrop. And as the equity markets stay healthy, as the IPO market grows, it's a little bit of a magnet pulling things in. So to me, on some of these great companies we own, it's really a question of when, not if. And when we think it's the right time, we'll do it. Market conditions getting better is obviously very helpful for our business.
Now, I want to read you a quote from Oppenheimer off the heels of your results this morning. They said Blackstone is deploying more in real estate than it is realizing, indicating some bullishness on its part as it puts more money to work than it's taking off the table. Do you agree with that categorization? Can you give any color around how bullish you might be?
I would agree with that characterization. I guess what I'd say is real estate has also been through a tough patch here now for 3.5 years. It was a combination of COVID in the office market and then just the rising cost of capital. Interest rates went up a bunch, and so multiples came down in real estate. Cap rates went up. But we're beginning to see some promising signs as we look forward. We're seeing new supply come down pretty sharply, and that takes a bit of time because of the lag between construction going down and new deliveries. That's going to start to show up in the fundamentals as we head towards the end of the year into next. And cost of capital's coming down. Borrowing costs, spreads, base rates, that's helpful. And we're seeing the early signs of transaction activity starting to accelerate, particularly amongst smaller assets. The CMBS market's up something like 40% year to date. And so real estate's a cyclical business. Apartment demand, logistic demand, these things are not going away, but you have to work through this cycle. We're at that point. We're getting closer, I think, to this tipping point where the market sort of bottomed 18 months ago. We talked about that. Then we said it wouldn't be a V-shaped recovery. That's what's happened. But when we look out over the horizon, things certainly look better for real estate. And of course, the way we react to that is by trying to deploy capital ahead of that recovery.
What you're speaking to is an easing of conditions before we've even seen successive rate cuts this year from the Federal Reserve. Obviously, the president has been very vocal for his desire to see much more aggressive cuts than the market is pricing in. Do you worry that cuts, subsequent cuts, could spur another bout of inflation at this point?
Well, I think the Fed has done a very effective job getting inflation down. They were a little late, as we know, originally to raise rates, but then moved quickly. And what we do is look at our proprietary data. We have 250 companies and 13,000 pieces of real estate. And consistently for the last couple of years, others have been talking about sticky inflation. We've just been looking at the proprietary data we have. And it continues to show inflation heading lower. Shelter costs, which are the biggest component of CPI, are running well below the government's 3.8%. And so we think that'll come down. Energy costs obviously coming down. And when we survey our companies about the labor market, they're saying it's the easiest to hire that it's been since COVID. Wage growth is now down back around 3%. So I think the Fed's going to have a lot of good data. We could see an uptick in goods inflation given what's happening in policy. But in aggregate, I think inflation continues to drift down. As a result, I think the Fed has the room to cut rates. So I don't think, given where inflation is, that's going to reignite a bout of inflation. And so I think that will happen gradually. Given the tariffs, given low unemployment, the Fed is being patient. But I think the facts will give them the room to cut rates. And that, again, should be helpful to the economy. It should be helpful to markets.
With all the rhetoric, the push-pull between the president and the Federal Reserve that we've seen, on again, off again, threats to even let the Fed chair go, do you worry about Fed independence from where you're sitting?
Well, in the last couple of weeks, I think we've heard from both the president and the Treasury Secretary that they expect the Fed chairman to continue to the end of his term. I think the Fed will continue to be independent. The president will have a choice to make a replacement here. And I think this system has worked well over time. I think it continued to work well. There's a board of governors as well. So I think the system works. And ultimately, there have been friction between the administration and the Federal Reserve over time. This isn't the first time. But I have a lot of confidence, just like I do in the entire Madisonian system in the U.S. And ultimately, I think the Fed will make the right calls based on the data.
That was Blackstone President and Chief Operating Officer John Gray. And joining us here at the desk, Smriti Pompado. She is co-CEO and president of Dynex Capital, a real estate investment trust, so of course very in tune with the push-pull in interest rates that we've been seeing. Now, here's the question. Even if you believe what John Gray believes, that interest rates can come down at the short end this year, what does that mean? Matt and I have been talking about this constantly. What does it mean for the long end? Because it's not certain for many people that the long end would come down just because the short end is.
Absolutely. And this is one of the most dynamic things that's happened in the U.S. yield curve over the last 24 months is a disinverting of the yield curve, a steepening of the yield curve, where long-term interest rates are actually a lot higher than short-term interest rates, right? And to the extent that the Fed continues to cut rates, it's not a guarantee that long-term interest rates come down, because the long-term part of the yield curve, private investors determine the price of that. And that's usually a function of growth expectations, inflation, and a risk premium. And to the extent that there's uncertainty about Fed independence or whatever there is, that part of the yield curve reacts very differently. And so from our perspective, we think really the outcome there is a steeper yield curve.
So I guess it depends on who cuts rates and why that person or the board decides to make those decisions, right? Because I imagine if President Trump were to appoint, I don't know, say Scott Bessent, and then Scott Bessent were to cut rates dramatically because President Trump told him to, the market might react negatively to that.
Look, so first of all, it's not a single person that decides this stuff, right?
True.
Like there is a whole group of people, they have to vote. So that's thing number one. Thing number two, a lot of people think of the Fed as really having two mandates, which is maximum employment and stable prices. But they actually have a third mandate. If you go back and look at the Federal Reserve Act of 1977, they had a reform act that was passed at that time. The third mandate is actually to maintain moderate long-term interest rates. And when you take those three things together, that is also part of what the Fed can and will do. They have a toolkit in their pocket right now between QE, rates, the ability to put together any kind of market stabilization program. So they have the toolkit that they need to manage the yield curve if they want to.
But, one thing that I think is interesting is also the impact that the long-term rates have on the mortgage market also, because you're back to mortgage rates above 6.8% and a conversation around the privatization of Fannie and Freddie.
Yes.
Now, you worked for Freddie as managing their investment portfolio for almost a decade when it was private.
Yes.
So what do you think the impact would be if they achieve the privatization once again?
Yeah, and it's going to be very interesting to watch how that occurs. The most important piece of information that's come out about privatization happened in late May when President Trump actually tweeted out or put it on Truth Social that if the GSEs were to be made private, the mortgage-backed securities that have been issued by them would maintain their government guarantee. For investors like us, that's all you need to know, right? So that's really the biggest driver of what that mortgage rate is. So if you've got that government-backed guarantee, that helps you with respect to mortgage rates. Whether they're private or not, the ultimate structure and how they go about it, whether it's fast, whether it's slow, all of that will impact, the ultimate mortgage rate. But having that guarantee really gave the market a lot of confidence that things won't get out of control.
If I look at the average rate of the federal funds target rate over the last 50 years, say through the financial crisis, right? Not including the ZIRP period, we're below that still, right? It's, I think, 5.75%, and we're at 4.50.
4.5.
So is this really too high? Are we in a high rate environment?
In the large scheme of things, I would say maybe a little high, like maybe there's room to cut rates 50 to 75 basis points here. And I'm saying that just because we're watching the labor markets, and I think Chris Waller said they're dangerously close to the edge. We think they're walking closer to the edge, maybe not quite at the edge. So there is room for the Fed to lower rates here. But in general, we're going back to an environment where we have a lot of debt outstanding in the world. That debt has to be priced appropriately. So by and large, these don't seem like abnormally high or abnormally low levels of interest rates. They seem actually pretty fair here.
Let me ask about the housing market, because we got yesterday existing home sales that were a disappointment, and in general, it's been a tough, especially, now residential has been bad and the demographics don't look great either, right? Yeah. How does that play out, you think, over the longer term, 5 years, 10 years?
So existing home sales levels today are about as bad as we've seen them even since the crisis, right? And that's a reflection of the 7% marginal mortgage rate on 30-year mortgages. And if you go back and look at existing home sales over time, what you'll find is they go through boom and bust periods. We are in a bust period for housing right now. It's directly related to the level of mortgage rates. To get that market moving, you need lower mortgage rates, period.
But maybe what about the demographics? We're going to have, all of us are going to be 70 years old and older, right?
Yeah.
There's no more kids to start families.
So then you've got this idea of the silver wave where the aging boomers are trying to get out of their houses. There was talk this week about reducing the capital gains on house gains, selling your house and getting the capital gains. There's a tax on that now. If you reduce that, maybe that creates a little bit of velocity. But look, behind the boomers are the millennial generation. The millennial generation formed households late, and they came into the housing market late. They are still there as a source of demand for housing. Okay, so that's not going to be gone anytime soon. So they will be there to catch what I think is what the boomers are going to sell eventually.
Smriti, we thank you so much for joining us here on set. That is Smriti Pompano of Dynex Capital. We got to leave it there, but of course, complicated housing market and complicated interest rate environment too. So to talk more about that, coming up, Counselor to the Treasury Secretary Joe Livornia discusses the impacts of tariff-driven inflation, if they're seeing any, and the revenues they're bringing in from it. Importantly, stick with us. This is Bloomberg Open Interest.
I'm not really sure what the Federal Reserve is looking at, because thus far, we have not seen, or we've seen very little, if any, price pressures from the tariffs. And if we were to see those, they wouldn't be inflationary, it'd be a one-time price adjustment.
Treasury Secretary Scott Bessent telling Bloomberg that tariffs would be a one-off for inflation. Let's bring in Counselor to the Treasury Secretary, Joe Livornia in Washington. Joe, I'm actually very curious about where you think that these rates are actually going to start leveling off, because you went from 10% to 15%. The market had been digesting that double-digit percentage in tariff rates. Do you think that it could be higher, much higher for countries that would bring the ultimate global rate above that 15% level?
Shonali, thanks for having me. It will depend, as Secretary Bessent has said many times, on how negotiations go. As he highlighted several weeks ago, there would be a bunch of deals all coming through as people were eager to negotiate with the U.S. And, of course, President Trump came in and solidified a great deal with Japan, among other countries. And we'll just have to see how things progress. As you know, with China, the Secretary said earlier in the week, we're in a good place. He is going to Stockholm next week to negotiate with his Chinese partners, so we'll see what happens. But clearly, we've made a lot of great deals with some really huge trading partners, so we're progressing, and we'll see what happens from here on out. But as you mentioned, the tariffs have generated significant revenue, as we thought they would. We could end up with $300 billion or thereabouts in calendar year revenue. That's stunning. And as the Secretary highlighted, and this was the case well before these tariffs were even implemented. Even last year, we were talking, or he was talking, I was saying in the private sector, that there was not going to be an inflation impact, because inflation is always and everywhere a monetary phenomenon. If there even was a tariff effect, it would be a one-off price level adjustment, and we've yet to even see that.
It does seem that, first of all, revenue could be higher than $300 billion, right? If we have a base rate of 15% on essentially $3 trillion of goods, you could see $400 or more billion. You could see $4.5 trillion of revenue over the next decade. How do you see that shaking out, Joe?
So you're correct, Matt. And again, the $300 billion is just based on current trends. If those rates turn out to be higher, then yes, the revenues will be higher. The CBO, when it did its analysis of the tariff several weeks ago, thought it'd be around $3 trillion. That's important because they erroneously, in my opinion, we could talk about, scored the one big original bill. The one big beautiful bill, they originally scored that as adding $3.4 trillion. So basically the tariffs would effectively wipe that out. And that was with ridiculously pessimistic forecasts. What I see playing out is the following. We have a CapEx boom. We could talk about that. We're seeing that in the data. We're seeing a boom in blue-collar wages because of President Trump's energy policies have lowered inflation significantly, and the CapEx story will lead to further wage gains through productivity. And to the extent that tariffs induce more countries and companies to relocate here, at the same time the incentives from the One Big Beautiful Bill encourage more domestic production, you'll get faster growth and low inflation. So it's a win-win. So we think you're going to see a real boom in the manufacturing base, higher living standards, and bigger paychecks for Americans.
Can I ask you about the Gold Card program, Joe? Because it sounds like a niche issue, but I've heard Secretary Lutnick talking about 75,000 applicants, which would be also like $400 billion in income that you could potentially see on an annual basis. So is that program set to move forward, and do you have any idea at what scale?
What I can say is I'm not sure what exactly will happen with that program, but I think the most interesting thing about the program is just how creative and visionary the president is. I mean, he totally thinks outside the box, and you could see this week with the innovation fund that he is basically pushed through at a higher number than even the Japanese originally wanted. He's pushing that through in that deal, $550 billion. And the profits almost entirely going to U.S. entities. That's like pretty cool. That's pretty innovative itself. And, you know, all these things that President Trump is coming up with is just a new way of thinking about how things can get done. You know, President Trump wrote the best-selling book, Art of the Deal. It's also, you know, producing the art of the impossible. And I know that sounds like it's exaggerated, but in reality, it's not. And I think we can go in these really cool directions.
Joe, I want to go back to something you were saying about CapEx spending. It is clearly something you and the Treasury Secretary are looking at. But when you look at the breakdown, it's pretty interesting. You can see the spending on industrial production as it pertains to information processing just really taking off. But you don't see that same uptick at that rate by any means for the parts of the economy that are more manufacturing driven so far, more production, more kind of classical production, if you will, industrial production. So when does that start to catch up? Because ultimately, Go ahead.
Yeah, no, that's a great point. So if you look at, we had a 24% increase in the official GDP data. The AI, computer, innovative part of the economy grew over 70%. But industrial equipment itself grew almost 5%. That's a pretty strong growth rate. Transit equipment was up about 7%. So we did see some of that growth in the first quarter. It was just overshadowed by the AI boom. And as we build data centers and become the leader in digital assets and crypto, that will further foster high-paying manufacturing jobs. And the fact that the One Big Beautiful Bill has the 100% expensing for factories and plants, something that we never had before in tax policy, means we're going to get the building. So some of the older industrial aspects of the economy will start to benefit from that. It's just that this bill was just passed, a few weeks ago. So I'd imagine we'll break ground on a lot of these new projects soon, and you'll start to see things like structures, which actually aren't part of CapEx, actually pick up in a pretty meaningful way.
Mr. Counselor, appreciate your time. Hope we can get you back in the studio soon. Counselor to the Treasury Secretary Joe Lavorgna out of Washington, D.C. This is Open Interest. Let's get a check on the markets right now. We are looking at some big green arrows with the S&P 500 at 6,376. The NASDAQ also gaining a 0.25%. Let's get a look at some of the single stocks at this hour. ServiceNow.
Yeah, pretty
which
interesting.
is good because Bill McDermott's coming on later.
He is, and this is another AI story, customer adoption of AI tools. We want to see a B2B adoption here as well as a B2C adoption. We're also looking at Mattel, also really interesting to me because you're seeing it just plunging about 12%. They reissued a sales growth forecast that was crimped by tariffs. Chipotle also cut its annual outlook.
You don't need 30 dolls, Shonali. 1 or 2 dolls.
Don't tell me how many dolls I need, Matt Miller. How many burritos do you want?
I want way too many burritos, and I'm hoping instead for a supply of Wegovy to cut that consumption. Coming up tomorrow, we're going to speak with the CEO of the prediction market Kalshi, which is absolutely fascinating. Also the CEO of Reflexivity, which has nothing to do with indigestion, and an AI firm partly owned by Stan Druckenmiller.
Super interested in the AI trade over there, as we know, public and private. Looking forward to that conversation next. Matt, really interesting. Today might be another day of records.
It could. Well, it is as we speak, and it could be if the trend continues of markets rising from here on out. This is Bloomberg Open Interest.
Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, President Trump signed executive orders to boost AI development in the US. We'll dig deeper with White House officials Michael Kratsios and Sriram Krishnan.
Plus, we get back to big tech earnings with Tesla and Alphabet's results. Tesla sliding after Musk's warning for the quarters to come.
And Intel's next on the docket. We'll discuss what to expect from the chipmaker's results and its turnaround efforts later today.
But Ed, first we check in on these markets that are once again at record highs. We're focusing in on what has really been the uplift, feel-good factor of the fact that the trade deals start to roll in. Japan, all eyes on Europe, and we look at the Nasdaq, currently up 0.25% if you're looking at the Nasdaq 100, but it had been at new record highs. We're seeing it on other benchmarks as well, and I know you're digging in to the key contributors to the upside and the downside in terms of points.
Yeah, let's go on the downside. Tesla is the earnings story, on track for its biggest drop since the first week of June, a period of transition and the core business suffering. Alphabet is AI-fueled growth, but at a greater cost, raising CapEx. Later in the show, going deep on both those names. And Nvidia in this session is pushing fresh record highs. Jensen Huang front and center of yesterday's Winning the AI Race Summit, but sprinkled within that, a warning from the president about how closely he's looking at Nvidia. Let's get out to Bloomberg's Michael Shepard here in Washington, D.C. The executive orders are the fresh bit. Action by this president to enact his AI action plan, a standing ovation for Jensen Huang, and within it, a warning, so to speak.
Well, that's right, Ed. In this, we saw President Donald Trump embrace artificial intelligence as a pillar of his economic and national security agendas. And with it, we saw him practically throw his arms around Jensen Huang himself during the event, singling the NVIDIA CEO out for praise, really for the company's prowess in making the AI chips that power this new and transformative technology. But he did sprinkle a warning in there. Before going on to praise Jensen, he let it slip that he had thought about trying to break up NVIDIA, which would be a startling and very much a market-shaking move. And yet he said that he was talked out of it by aides who pointed to the company's importance and how it had taken years to develop that preeminence. And if the U.S. government had gone after NVIDIA, it would be really hard, Ed, to walk that back.
Mike Shepard on the latest out of that AI Action Plan event. And let's get more analysis, more people in the room. Michael Kratzios is one of them, director of the White House Office of Science and Technology Policy. And it was, let's just start, such a enthusiastic welcome, embrace of AI writ large. Michael, I got to get your take. It was perhaps jovial in nature coming from the President of the United States. But what did you make of the fact that he'd once upon a time considered even thinking of breaking up NVIDIA?
I think it was a tremendous day for the country and for AI more broadly. We definitively turned the page on what the last administration had tried to do to really hamper this industry and shackle it with a high level of regulation that didn't allow it to fully spread its wings. What was tremendous about the event yesterday was not only the president's speech, but the participation of the vice president himself and 5 cabinet secretaries. This was a big moment for the American AI industry, and it really showed how committed this administration is to ensuring continued American dominance in this critical technology.
Mr. Kratzios, you helped to write this document and form the policy alongside the advisors David Sachs and Sriram Krishnan, who will be on the program later today. What I got from corporate America is that they feel the action plan is actionable, it's heavily rooted in deregulation and expediting permits. Of the 23 pages, which section do you think gets enacted by this administration first?
Well, we are racing ahead on all of them. I think the one piece that you didn't mention, which I think is also very critically important, is this focus on exporting American AI. This idea that we want the entire world to be running on American artificial intelligence stack. That is our cloud, our chips, our algorithms. All of that needs to be exported and packaged to the world so that we become the ecosystem of choice globally. And that is